Hi, my name is Liz Bowen. I am a realtor and the owner of Red Bow Realty here in beautiful Colorado Springs, Colorado. And in today's video, I want to talk to you about what's happening right now with mortgage interest rates. In July, the average 30-year fixed rate mortgage fell below 3% for the first time in history. And while many Americans have rushed to take advantage of this unprecedented opportunity, others question the hype. Are today's rates truly a bargain? While average mortgage rates have drifted between 4 and 5% in recent years, they haven't always been so low. Freddie Mac began tracking 30-year mortgage rates in 1971. At that time, the national average was 7.31%. As the rate of inflation started to rise in the mid-70s, mortgage rates surged. It's hard to imagine now, but the average U.S. mortgage rate reached a high of 18.63% in 1981. Fortunately for home buyers, inflation normalized in October of 1982, which sent mortgage rates on a downward trajectory that would bring them as low as 3.31% in 2012. Since 2012, 30-year fixed rates have risen modestly, with the daily average climbing as high as 4.94% in 2018. So what's causing today's rates to sink to unprecedented lows? Economic uncertainty. Mortgage rates generally tend to follow bond yields because the majority of U.S. mortgages are packaged together and sold as bonds. As the coronavirus pandemic continues to dampen the economy and inject volatility into the stock market, a growing number of investors are shifting their money into low-risk bonds. Increased demand has driven bond yields and mortgage rates down. However, according to the National Association of Realtors chief economist Lawrence Yun, the number one driver of low mortgage interest rates is the accommodating Federal Reserve stance to keep interest rates low and to buy up mortgage-backed securities. According to Yun, we will see mortgage rates stay near this level for the next 18 months because of the significance of the Fed's stance. Low mortgage rates increase buyer demand, which is good news for sellers. But what if you don't have any plans to sell your home? Can current homeowners benefit from falling mortgage rates? Well, yes, you can. The growing number of homeowners are capitalizing on today's rock bottom rates by refinancing their existing mortgages. In fact, refinance applications have surged over the past few months, and for good reason. Reduced interest rates can save homeowners a bundle on monthly payments and total payments over the lifetime of a mortgage. Here's a chart that illustrates the potential savings when you decrease your mortgage rate by just 1 percentage point. When it comes to refinancing, the bigger the spread, the greater the savings. So for example, on a $300,000 loan amount at 4% interest, your principal and interest is $1,432. But at 3% interest, that drops to $1,265, a monthly savings of $167 that translates into a savings of over $60,000 over the span of 30 years. Be sure to factor in any prepayment penalties on your current mortgage, if you have any, and closing costs for your new mortgage. For a refinance, expect to pay between 2% and 5% of your loan amount. Now, you can divide your closing costs by your monthly savings to figure out how long it would take you to recoup your investment, or you can use an online refinance calculator. For a more precise calculation of your potential savings, we'd be happy to connect you with a mortgage professional in our network who can help you decide if refinancing is a good option for you. We've already shown how low rates can save you money on your monthly payments, but they can also give a boost to your budget by increasing your purchase power. For example, imagine you have a budget of $1,500 a month to put towards your mortgage payment. If you take out a 30-year mortgage at 5%, you can afford a loan of about $279,000. Now let's assume that the mortgage rate falls to 4%. Well, at that rate, you can afford to borrow $314,000 while still keeping the same $1,500 a month mortgage payment. That's a budget increase of $35,000. If the rate falls even further to 3%, you can afford to borrow $355,000 and still pay the same $1,500 each month. That's $76,000 over your original budget, all because the interest rate fell by 2 percentage points. If you've been priced out of the market before, today's low rates may put you in a better position to afford your dream home. On the other hand, rising mortgage rates will erode your purchasing power. If you wait to buy, you may have to settle for a smaller home in a less desirable neighborhood. So if you're planning to move, don't miss out on the phenomenal discount you can get with today's historically low rates. I wish I had a crystal ball. No one can say with certainty how low mortgage rates are going to fall or when they're going to rise again. A lot will depend on the trajectory of the pandemic and subsequent economic impact. Forecasters at Freddie Mac and the Mortgage Bankers Association predict that 30-year mortgage rates will average 3.2% and 3.5% respectively in 2021. However, economists at Fannie Mae expect them to dip even lower to an average of 2.8% next year. Still, many experts agree that those who wait to take advantage of these unprecedented rates could miss out on the deal of a lifetime. With rates now at all-time historic lows, it's hard to imagine that people may be holding out for something better, warns Paul Bugie, President and COO of Inlanta Mortgage. Positive news about a vaccine or faster than expected economic recovery could send rates back up to pre-pandemic levels. While I can talk to you about average mortgage rates, please understand that the mortgage rate that you qualify for depends on a lot of things. So you'll want to talk directly to a mortgage professional to find out how these historically low interest rates affect you. Things like your credit score, things like your debt to income ratio, and other factors will impact what interest rate you would be able to qualify for. But I just got an email this morning that I want to share with you. And today is August 6th, and interest rates for a VA loan, if you have a 680 plus credit score, could be as low as 2.25%. For FHA loans with a 3.5% down payment, if your credit score is 680 or above, you could qualify for the same 2.25% interest rate. These rates are just amazing. A conventional loan with a 720 credit score or higher and 5% down is at 2.625% right now. Just amazing, under 3% interest rates that you could qualify for. If you'd like to talk to a trusted lender, then I highly encourage you to visit my website. We're at redbowrealtyusa.com. And if you click the Mortgages tab, you'll find several wonderful loan originators and highly trustworthy individuals who can give you advice and counsel on what these low interest rates mean to you. So here's some pieces of information that I think might be really helpful for you. Basically 5 tips when you're thinking about how you can leverage these historically low interest rates. The first is to consider a 15-year mortgage instead of a 30-year mortgage. Now, if you can lock in a lower rate than what you're currently experiencing on your 30-year mortgage, you could save money in your monthly payment and pay off your home in half the time. Now, this is a huge boon because, as you know, the amount of interest that you pay on your loan over 30 years is substantial, hundreds of thousands of dollars. If you can cut that term in half, then you'll be paying considerably less money in interest payments, which ultimately saves you a lot of money and gets your home paid off much sooner. I personally was able to refinance from a 30-year mortgage into a 15-year mortgage several years ago and am very, very happy. My payment at that time only went up by about $20, and I'm proud to say that we'll have our home paid off in only 8 years, something I would have never thought was possible. So again, this might be a great time for you to consider refinancing, not into another 30-year fixed mortgage, but into a 15-year mortgage, substantially saving you lots of money when it comes to interest payments and building more equity faster, paying off your home much quicker. Here's something else that you can do to potentially qualify for these really low interest rates. And that is to think about how you can give your credit score a boost. The economic downturn has made lenders more cautious. These days, you'll probably need a credit score of at least 740 to secure their lowest rates. Now, while there's no fast fix for bad credit, you can take steps to help your score before you even apply for a loan. The first is to dispute any inaccuracies that are on your credit report. You can also pay your bills on time and catch up on any missed payments now. Hold off on applying for any new credit. Pay off debt. Keep balances low on your credit cards, but don't pay off or cancel your credit cards. And then don't close any unused credit cards unless they're charging you an annual fee. Another way that you can qualify for low interest rates is to put a large down payment on a property so you're financing less. The more equity you have in a home, the less likely you are to default on your mortgage. That's why lenders offer a better rate to borrowers who put a sizable down payment on a property. Plus, if you put down at least 20%, you can avoid paying for private mortgage insurance. Now, please understand, you don't have to put 20% down to buy a home. VA loans are 100% financing. FHA loans only require a 3.5% down payment. And there are many conventional products that require 5% or a little bit more than that to qualify. But the more money you put down, the better the rate that you might qualify for. So consider whether saving up money now and gathering as much as you can so when you're ready to make a purchase, you would qualify for a lower interest rate is something in your budget. Another strategy is to pay for points. Now, discount points are fees that are paid to the mortgage company in exchange for a lower interest rate. We call it buying down your interest rate because you're providing money up front to the lender. In exchange, they're reducing your interest rate, which will reduce the money that you have to pay over time. At a cost of 1% of the loan amount, they're not cheap, but the investment can pay off over the long term in interest savings. My last point is to shop around. Rates, terms, fees, they can vary wildly amongst lenders. So do your homework. Contact several lenders on my website, again on the Mortgages tab, and have frank, honest conversations with those folks about what they offer and what you qualify for. Be sure to complete the process within 45 days, or else the credit inquiries by multiple mortgage companies could have a negative impact on your credit score. Are you ready to take advantage of the lowest mortgage rates in history? Just remember, mortgage rates have never been this low. Don't miss out on the chance to lock in a great rate on a new home or refinance your existing mortgage. Either way, we can help. We'd be happy to connect you with the most trusted mortgage professionals in our network. And if you're ready to start shopping for a new home, we'd love to assist you with that search, all at no cost to you. Contact us today. Visit Redbow Realty's website at redbowrealtyusa.com. The home search functionality on our website is top-notch, and I know you'll enjoy looking at properties in either El Paso County or South Denver, Castle Rock, and Monument areas straight from our website. Thanks for watching this video. I hope it's answered some questions for you about how low mortgage interest rates impact you directly. If you'd like to learn even more, scroll down on the end of this blog page and you'll find a list of resources that were used to put this blog together. Again, my name is Liz Bowen. I'm a realtor and the owner of Redbow Realty, and what's important to you is important to me.